So financial provisions are provisions in the PPA that address some of the key questions for all parties and primarily for power producers. The questions that they answer are how much power is being purchased, at what price, and when is the payment due? One of the key components of the financial provisions is the tariff and the entire tariff structure. So what is a tariff? It's an amount of money that the off-taker will pay to the project company, usually each month. And the tariff-related provisions detail the actual price paid by the off-taker to the project company for the capacity made available or for the energy generated. They also detail the currency unit used, as well as a broader set of terms and conditions that surround the price. There are different tariff structures that are used for dispatchable and non-dispatchable technologies. Most non-renewable energy sources fall within dispatchable technologies. A dispatchable technology is one that can be dispatched by the off-taker, giving an instruction. They will give an instruction to the project company to generate a specific quantity of energy, and the project company, because of the dependability of the fuel source, is able to do that. When it comes to renewables, they're split relatively evenly. Some renewables are dispatchable. Those are biomass, waste to energy, geothermal, and large hydroelectric. Other renewable power sources are not dispatchable. Solar, wind, wave or tidal, and small or run-of-river hydro. Non-dispatchable technologies are those that can't be dispatched by the off-taker upon command, usually because of the unpredictability of the fuel resource, the sun or the wind. So as I noted, dispatchable technologies have different tariff structures than non-dispatchable. I'll begin with the dispatchable technologies. They're usually structured as capacity-based tariffs. So those include a capacity charge for the amount of capacity that a power plant has that is made available to the off-taker. They also have an energy charge for the energy that is dispatched by and delivered to the off-taker. And they may be held to take-or-pay clauses in long-term fuel supply agreements. Non-dispatchable technologies typically have an energy-only tariff that is stated in a currency per kilowatt hours or megawatt hours. And they will typically also include the principle of deemed energy, which applies either prior to scheduled COD or after scheduled COD if there is a curtailment. And I think each of these concepts bears further detail. So we'll break them down right now. For dispatchable technologies, the capacity-based charge is sized to enable the project company to earn revenues under the PPA that are sufficient to enable the project company to cover 4 cost components: repaying its debt, paying the sponsors a return on equity, paying all of its taxes, and paying for fixed operation and maintenance costs. The energy payment or charge is sized for the project company to cover the cost of its fuel and to pay for variable operation and maintenance costs. For take-or-pay clauses that may be present in fuel supply agreements for dispatchable technologies, those typically will have an impact on the tariff regime or structure in the PPA. Essentially, a fuel provider is allocating an amount of a finite resource that it has to the project. If the project is not able to take it, the fuel provider doesn't want to be left holding the bag. So they will nonetheless require that project to pay for it, take or pay. If the off-taker doesn't dispatch a project sufficient to allow it to take up to the take or pay amount, the off-taker may be required in the PPA to pay a makeup amount to get to the take-or-pay amount to cover the costs of the project company. Now, in talking about the payments for non-dispatchable technologies, those are slightly different. Non-dispatchable technologies, typically the energy is for energy delivered to a certain agreed point, and then the concept of deemed energy differs depending on the transaction, but essentially non-dispatchable renewable energy plants will also be entitled to deemed energy payments in cases of deemed completion. These payments are usually calculated based on the reliability of the solar or wind resource of the project, usually using a P50 if you're a developer or a P90 if you're a lender calculus. Thereafter, following completion of testing, if the plant performance tests determine a lower than contracted capacity, the project company usually has to take account of the difference. There is also deemed energy after commercial operation date, and that's typically for an extended curtailment by the off-taker or the grid operator. And the main reasons that require the off-taker of a non-dispatchable plant to pay for deemed generation are the likelihood of a prolonged curtailment is more significant in a particular market, or the host government may have a controlling interest in both the off-taker and the transmission system operator. In the latter case, investors will be concerned that the off-taker may cause the transmission system to curtail generation in the event that the off-taker may purchase energy at a lower price from other sources. So that's why parties would typically require a deemed energy payment for post-COD in certain markets. Next slide. Something that's also very important, primarily for renewable energy sources, are feed-in tariffs, or FITs. It's a tariff commonly used to incentivize the production of renewable energy. It's a fixed tariff, and it's often differentiated by technology type. It provides certainty on three key terms for the producer. It provides guaranteed access to the grid, subsidized energy price, and a long-term PPA. Now, feed-in tariffs are typically in place for a set term where parties have an amount of certainty as to whether or not they qualify for that feed-in tariff. Feed-in tariffs are periodically revised from time to time by regulators, typically to capture lower capital costs. Nowhere is this more evident than in the PV solar market over the past, say, 15 years. The price in 2008 was far in excess of the price of constructing a PV solar plant today. So many regulators took the opportunity every few years to come out with a new feed-in tariff that reflected the lower cost for developers developing at that time. Next slide. So the tariff structure is certainly a very important element of the PPA, but another one that is helpful for both producers and off-takers to keep in mind at the outset when negotiating a PPA is the potential for refinancing. In particular, given the large percentage of overall project costs represented by the financing at the outset, it's something that the parties should keep their eye on. A project company may seek to refinance its loans to reduce the cost of debt and increase equity returns, and also to reduce foreign exchange risk. But the project company is the one that will determine whether or not it will refinance. And essentially, it needs to be incentivized to do so. So while a PPA may seek to take the benefit partially of a refinancing, it should not seek a full pass-through of all reduced costs associated with the refinancing, because by doing so, they would be disincentivizing the power producer from going through the time and expense required to find and negotiate the terms of new financing. That said, refinancing does provide off-takers and sponsors the opportunity to benefit from reduced costs over time. With regard to reduced foreign exchange risk, it's often the case that local lenders who would be best positioned to lend in local currency are not able to take the pre-construction risk of a project, but after COD is reached, they are far more likely to be able to refinance in local currency. This is particularly beneficial for the off-taker, who would typically at the outset be required to make tariff payments in a hard currency or reserve currency, while it's charging its customers local currency. So to be able to match those currencies over the long term is beneficial to the power producer, the off-taker, and ultimately to the end consumer. Next slide. So invoicing and payments. They don't seem as interesting as some of these other topics, but in fact, they're crucial. In order to get paid for the energy it delivers, the seller must invoice the buyer. That's usually done monthly. The invoice is typically going to include the capacity payment, the energy payment, and any supplemental payments, depending on the type of technology involved. That invoicing regime needs to be agreed transparently upfront so that the timing implications of invoices and when payments are due is understood by all of the impacted parties. It will be relevant for the off-taker because they need to know when they need to have the amounts required to make the payment. The producer will need to know, as will the lenders, because they will need to align their debt payment schedule with those invoicing amounts. And if in a particular market there is a lag in payments historically, that's something that all parties will need to take into account. Payments fall into two categories, which are pretty self-explanatory. There are undisputed payments, and those must be made in an agreed currency at an agreed time by the parties. And then there are disputed amounts, and those are withheld from payment and contested, but typically an interest rate will apply to the contested amounts. Late payments are also typically subject to an agreed interest rate because there are implications for primarily the producer. They have to pay interest on their debt to their service providers or to their debt providers. So it is something that needs to be taken into account. Next slide. Tax exemptions. To incentivize investment in the energy sector, a host government may provide economic incentives in the form of tax exemptions. They can be exemptions from custom import duties, reduced registration fees, reduced VAT, and then also an income tax holiday during the operational phase. Tax exemptions improve a project's financial viability and they encourage investment, thus allowing a lower tariff that benefits electricity consumers. For all parties concerned, however, any tax benefit should be very clearly and transparently detailed, and the power producer will want to ensure, with the benefit of their local council's advice, that they qualify for the tax exemption and that the local tax authority won't have any misunderstanding with regard to that qualification. Because there's nothing like relying on a tax exemption and then completing a plan and discovering that the tax authority is taking a different. That concludes my remarks. Thank you.